I know you've heard a lot about insurance costs over the last couple of years, and despite 2024's natural disasters and expectations surrounding the California wildfires in 2025, many now believe that we've reached stability on that front. Welcome back to Keeping It Real Estate. I'm your host, Mike Roeder, and today we're going to dive into my takeaways from the NMHC Annual Conference that I attended in Las Vegas this week. And for those of you that are not familiar with the annual NMHC Conference, it's really a premier gathering for the multifamily industry, brings together some of the top owners, operators, investors, industry leaders, brokers, property management teams, equity firms. And this year, I believe they had over 3,500 attendees. It's where some of the biggest deals happen, market trends are discussed, key insights into the future of multifamily real estate are shared. And it's really not just a conference, it's a high-level networking event where real decision makers in the industry come together, connect, strategize, and set the tone for the year ahead. So one thing was very clear at NMHC this year. Most investors and firms out there did not hit their 2024 deployment goals, which really means that investors are looking at more aggressive targets for 2025. And that's on the LP side, that's on the GP side, that is across the board. And the overall consensus is that we should see some really good opportunity in 2025, especially the latter half of 2025. So the other consensus was the landscape remains challenging, but for the investors out there that are more sophisticated, that means opportunity if you know where to look. In today's episode, we're breaking down what we learned and what it means for you when considering investments in 2025. So the first thing that we're going to talk about in regards to takeaways from NMHC is the debt market, some challenges out there, and then also some potential shifts. So securing financing remains one of the biggest hurdles in today's market, and that's not going away anytime soon. Agencies, Freddie Mac, Fannie Mae, they continue to be the go-to for non-recourse debt. Unlike a couple of years ago where it was mostly bridge debt, CMBS debt, possibly some local bank debt. But underwriting has become more scrutinous on the agency side. So they're taking a closer look at all the details of every single asset and being a little bit more picky about what they bring on. So make sure to tune into that if you're going out there and you're taking a look at an asset and underwriting an asset. Alternative debt solutions may be emerging with early conversations about a potential competitive agency alternative. It's something that we're keeping a close eye on. Interest rates continue to be very volatile. And at the conference, no one was certain that we're going to be seeing interest rates drop over the next couple of quarters. The overall consensus was that interest rates will eventually drop, but that it might take 6, 12, 18 months to see a decent amount of relief. Really, what's needing to be done first is we need to figure out what's going to happen with inflation, especially with, the possible tariffs, the possible migration issues and deportation that we might have coming our way. So those things will factor into inflation, and we need to figure that out. One other interesting conversation that I had was in regards to housing and how a very large portion of the inflation reports is housing, and the housing data actually lacks about 6 to 12 months. So there's a lag of about 6 to 12 months. So we should see inflation ease because rents have come down a pretty significant amount over the last 12 months, and that hasn't caught up on those reports. So sure, you might have some inflation because of these possible tariffs that are kicking in, or because of, the possible deportation. Wages might have to go up because we're losing those blue collar workers. However, there might be some relief on the housing aspect as well. So keep that in mind. One other really interesting thing that we heard across the board was that there's more originators for loans and brokers on the sales side that are leaving the space. And this just signals how tough it is to get deals across the finish line right now. I did have some conversations with brokers. There's a lot less amount of deals that are falling through, after being put under contract. It seems like more of the deals that are being put under contract are getting to the finish line. So that's very good news. Looking back a year ago, about 50% of the deals that were going under contract were falling out of contract, typically because the equity wasn't being able to be raised. Now that's increased. From what I had heard, about 70 to 80% of those deals are now getting across the finish line. So that's some good news. But again, there's going to be some really good opportunities in 2025, some distressed deals, some deals where people are just ready to recycle capital. So we're very excited to move into 2025. All right, so institutional capital remains focused on newer assets. So that was another topic of NMHC. Mainly 2000s and newer properties, but also well-located 1980s and 1990 buildings. Buyers are underwriting neutral leverage and targeting deals below replacement cost, and that's really in an effort to weather near-term rent softness. So you're still seeing some rent softness, and as you move into the latter half of 2025, we should see those rents increase and see some nice rental growth. Concessions continue to persist. So in Dallas-Fort Worth, approximately 40% of properties right now are offering concessions. And this is the highest level since 2020. So in the last 4 or 5 years, we're at the highest level right now. However, despite these headwinds, DFW remains a national leader, and concessions are expected to burn off in the coming months, and rent growth is expected to return. So that's very, very good news, especially what we went through over the last 2 years. We've seen concessions ramp up. We've seen vacancy tick up. We've seen delinquencies tick up. And really, the overall consensus at NMHC is that we're at the bottom of the market and we're starting to come out of that bottom, which is typically a fantastic time to invest in the multifamily space. A couple more details on DFW. Transaction volume rose in the DFW multifamily industry by 14% in 2024, with a strong second half of the year. So sales were increasing in 2024, not substantially. They're still down significantly from what they were in 2020, 2021, 2022, 2023, but they are increasing. And new construction starts have slowed, which should set the stage for rent recovery in 2025 and 2026. And then job growth remains strong, with 410,000 jobs added since 2020, keeping rental demand very, very steady. So what's next for multifamily investors? Most investors, just like I said, expect rent growth to return in late 2025. And again, this is going to be a very beneficial shift, as the market has seen some really lackluster rent growth, and in some markets, negative rent growth over the last year. And that's solely due to the amount of supply that's coming online. We've had record numbers of new units coming online, and obviously all those units need to be absorbed, and that takes time. One other notable shift in sentiment: insurance costs. I know you've heard a lot about insurance costs over the last couple of years, and despite 2024's natural disasters and expectations surrounding the California wildfires in 2025, many now believe that we've reached stability on that front. So insurance has risen significantly over the last few years, and this cost relief that we're seeing is being really well received. So taking a step back, we just switched all of our insurance policies over to a master insurance policy, and we saw about a 15 to 20% reduction in our insurance costs across the board, across our whole portfolio. And so that was a fantastic win on our side. What we're hearing out there is that a lot of people are seeing, somewhere in that 5 to 15% range in insurance premium reduction. So that is huge, huge news. Very, very beneficial for the industry. Obviously, any expense reduction just increases your value significantly, when you divide that by the cap rate. Now, I had the chance to sit down with our insurance team at NMHC and discuss the direct impacts of the California wildfires. Obviously, very devastating, terrible thing happening out there. But there's a lot of people that are curious on how that's going to impact the insurance industry, because you have so many billions of dollars of losses, in such a small period of time. And from their perspective, our insurance agent's perspective, the fires are fortunately not going to affect most carriers in Texas, Tennessee, and other states in the commercial space. And this is because California is very detached from the rest of the country in regards to what carriers are willing to insure commercial real estate. So the carriers that we utilize, for instance, they do not offer commercial insurance in California. So this eliminates the negative impacts of the fires on their future premiums. Now, if you take a look at the single family side of things, it's a lot different, because there's a lot of carriers that offer insurance nationwide, and they have California lumped into that. So the single family space insurance premiums may be impacted much more heavily compared to a lot of the commercial spaces, in Texas and Tennessee, which is where we, do most of our investing. Another major takeaway is that capital currently in the market is more sophisticated. So this says a lot. These sophisticated investors, these private equity companies, they know that we're near or at the bottom of the real estate cycle and that it's an advantageous time to deploy equity into the right assets right now. So they know we're at the bottom or we're at that smile, and they're buying large portfolios, large assets, trying to get their hands on some really good assets because they're able to buy for a really good basis. They're able to get in at a very low price with not a lot of competition. And they know that over the next 5 or 10 years, we're going to see the cycle continue to go up. Also, the overwhelming consensus among almost all the brokers I met with last week was that sales volume is expected to pick up by about 25% in 2025 compared to 2024. So going back again, saw an increase in sales volume by about 14% in 2024 in DFW. This year, brokers are expecting about a 25% increase. So that is great news as well. The more deals that are coming down the pipeline, the more opportunities you and I have to take a look and make sure that we're finding that needle in the haystack. Investors are also underwriting higher amounts for upfront CapEx. That was another topic. So typically 20,000, possibly more per unit for 1980s and older construction. And one of the reasons for this is because inflation has ticked up so significantly over the last 5 years that to turn units, to complete a roof repair or a roof replacement, complete the parking lot, any type of CapEx, it's costing a lot more than it used to be. So I think you have two things happening here. You have people wanting to make sure that they can cover those costs, and those costs have risen over the years. And then also you're having individuals, make sure that they have a little bit bigger buffer just in case something pops up when they're holding that asset. All right, so one other thing that was talked about a lot is that there are quite a few general partners and limited partners that are growing fatigued from feeding deals, especially assets that were bought in 2021 and 2022. They've been feeding the assets money. They may have bridge debt or floating rate debt where that debt is eating up a lot of the equity and the cash flow. And because of this, more assets are expected to hit the market in 2025. Some of these owners are going to opt to stop the bleeding rather than wait out a prolonged recovery. So it'd be ideal, if these owners are able to hold the asset for the next few years, let the market recover in most circumstances, and then sell. Well, some people have been so fatigued, or they may not have the cash, or they may not have the opportunity to refinance. And so they're in a position where they need to offload an asset for likely a very low price at this point in time because we're near the bottom. The decent thing about this is it presents some really good opportunities on the buy side, but it's really critical to understand, some key trends affecting performance right now. So number one, the strongest rent gains out there in DFW, from what we heard at NMHC, are in the older properties, so 50s, 60s, 70s properties, and then the newer properties, the 2000s properties. 80s and 90s properties are still facing rent declines despite decent occupancy. However, again, rent growth is expected to return in 2025. So that is a very good thing. And that's across the board, 60s, 70s, 80s, 90s, newer vintage properties across the board. And then market-wide rent growth is currently weak. So year over year in January, so January 24 to January 25, we saw negative 0.9% year-on-year rent growth. This is suggesting pricing pressure from increased supply or softening demand. So going back to how many units have been supplied over the last year, it's been a substantial amount. And because those all haven't been absorbed, you're seeing some negative rent growth. But again, moving into the latter half of 2025, we'll see that rent growth start to tick in the positive direction. For limited partners, 2025 is shaping up to be a year of both challenge and great opportunity. The market is shifting. Capital is cautious but sophisticated, and strategies need to be adaptable. If you're looking to deploy capital this year in 2025, there's a few things that you can do. First, focus on assets below replacement cost. So assets where you can get in significantly below what it would cost to build that building brand new. The other thing that we like to do is take a look at the cost basis compared to 2 or 3 years ago. What would the property have cost 2 or 3 years ago compared to what it costs today? What we're typically seeing is that it's about 25 to 30% lower than where it was a few years ago. Focus on markets with sustained job growth. Very, very important, because this gives you an indicator of how many people are going to be moving to the area. It also gives you an indicator of how stable your tenant base is. If there's a significant amount of jobs out there, that just gives you security that if they do lose their job, they're able to go out there and get another job. Focus on areas with pent-up demand. So there's still a lot of demand out there for multifamily housing, especially with the affordability gap being very, very high compared to what it costs to own a home, compared to what it costs to rent an apartment. And what we like to do is we like to dig in very deep on the primary data for the submarket for the asset that we're taking a look at. So what we do is we go out there and we shop the competitors. We take a look at all the industry reports, not just one industry report, but multiple industry reports. So CoStar, ALN, Berkadia, CBRE, all of these shops have great reports on what the demand looks like, what the vacancy, what the occupancy looks like, what the rent trends are, what the comps are getting for their rents. But anyway, you just want to make sure that you have pent-up demand in your submarket. What we usually look for is 95% plus occupancy, because what that means is while we're doing our value add on the asset that we purchase, we know that the tenants don't have a lot of places to go. And the less places that they have to go, the more likely they are to renew their lease when it comes up for renewal. Another thing that you should do is focus on sponsors who understand today's lending environment and capital expenditure demand. So lending environment, like we stated earlier, it's changing. It's very, very tough to get in with Fannie and Freddie. You want to make sure that you're getting the best possible loan. If you have a lot of experience and you have a good portfolio, a lot of times that's going to help you with your terms with these lenders. So you want someone that understands the lending environment. You also want to make sure that they understand all the terms. So the prepayment penalties, the length of the loan that they're putting in place. You want to make sure that you have enough runway just in case, there's hiccups in the economy down the line, or if something happens with the real estate cycle and it dips. You want to be able to work your way through that instead of being in hot water. And then the capital expenditure demand. So obviously capital expenditure costs have went up significantly over the last few years with inflation. So regardless of what type of asset you're purchasing or you're investing in, you want to make sure that the sponsor is very well in tune and knowledgeable with what they're going to have to spend on that asset. One thing that we like to do is we like to compare all of our assets of a similar vintage in a similar area and see what those assets over the years have been costing for CapEx, capital expenditures. So below the line items, things like bigger plumbing issues, roofing issues, HVAC, electrical. There's going to be things that pop up from time to time. And if you can get a good handle on what that approximate cost is per year or per unit, that can be very, very helpful on the investment side. So that's it for today's episode. If you found this valuable, be sure to subscribe and stay tuned for more insights. We look forward to seeing you on next week's episode of Keeping It Real Estate.